Hello and welcome to today's Investment Foundation Certificate live learning webinar. This session is on the power of alternative investments. This session will provide a comprehensive understanding of diverse asset classes and their potential to enhance your investment portfolio. I'm delighted to introduce Sonia. She's our instructor for today. Sonia is a CFA charter holder. She is a Senior Director for Education at CFA Institute, and she's a content lead for our Sustainable Investing Certificates.
Thank you, Catherine, and welcome everyone. Today, we are going to dive into the wonderful and exciting world of alternative investments. So this is what we'll cover today. We'll cover advantages and limitations of alternative investments, and then we will dive into three alternate investment asset classes, which is private equity, real estate, and commodity investments. Alternative investment are investments that fall outside the traditional asset classes of debt securities and equity securities. Private equity, which are investments in private companies that are not listed on a stock exchange. Real estate investments, it could be direct or indirect investments in land and building. And the third asset class that we'll talk about today is commodity investments. This could be investments in physical products such as precious metals, base metals like gold, copper. In energy products, think oil. Agricultural products that are typically consumed. Examples could be corn, cattle, wheat, or used in the manufacture of goods. For example, lumber, cotton, sugar. Let's talk about advantages of alternative investments. So there are 2 points to emphasize here. First is they can potentially enhance portfolio returns. So if you look at on your screens historical returns from 1990 to 2020, you can see the returns of US private equity over the last 5, 10, 20, 25 years compared to NASDAQ, S&P and S&P 500. We can see superior returns. So one is they can potentially enhance portfolio returns. And the second point is that they can also lower portfolio risk by providing diversification benefits. So if two assets or securities do not have a correlation of +1, if they are not perfectly positively correlated, then combining the two assets or securities in a portfolio may provide diversification benefits and thus reduce risk in the portfolio. As you can see that there is relatively low correlation between different types of alternative investments and also between alternative investments and other asset classes like stocks, bonds. Adding private equity, real estate, and commodities to portfolios helps investor reduce risk. So 2 key points to remember from this slide. These investments can potentially enhance returns and they can lower risk by providing diversification benefits. So I can tell you now that compared with traditional investments, alternative investments are less regulated. They are less transparent. They are less liquid, not more liquid like some of you felt, and they are more difficult to value. Because they are less regulated and less transparent than traditional investments, individual investors are less likely to invest in them. However, institutional investors may view this as an opportunity to take advantage of market inefficiencies. Most alternative investments are illiquid. They are difficult to sell quickly without accepting a significantly discounted price. And finally, because purchase and sales of startup companies, land, and buildings are infrequent, valuation is challenging and is often based on an appraisal. What is an appraisal? It is an assessment or estimation of the value of an asset and is subject to certain assumptions, which may not always be realistic. Let's move forward with the first asset class that we'll discuss today, which is private equity. Private equity firms invest in private companies that are not publicly traded on a stock exchange. Although people commonly refer to private equity, private investments can include both equity and debt. Private debt can include direct lending, which is private loans made without intermediaries. It can be mezzanine debt. It could be venture debt, which is private loans to startup or early stage companies. And it could be distressed debt lending, which is debt extended to companies that are at risk of defaulting. Private equity strategies. So we will talk about 4 strategies or 4 phases of a company's life cycle. Venture capital. Think of an entrepreneur who wants to set up her own business. She doesn't have the required capital, so she turns to her friends and neighbors for the money she needs. She starts her company. Now it's 5 years have gone. Her company is mildly successful, and she requires more capital to grow further. So to raise the additional capital, the company requires to support its growth plans. It could issue shares to the public via an initial public offering. But companies normally at that stage are not ready for an IPO. They can take a long time to get ready for an IPO. So we have established that the company is not yet ready to go public, but needs more money to grow than the entrepreneur, her friends, neighbors, and maybe banks were able or willing to provide. So who would have financed such a young and not well-established company? The answer is venture capital. The entrepreneur can sell some of her company's shares to a venture capital firm, which is a type of private equity firm, to get the additional capital necessary to grow her business. It is considered to be the riskiest type of private equity investment because it's at a very early stage of a company's life cycle. Venture capitalists specialize in financing new and young companies. They not only provide the money, the seed capital, they provide entrepreneurs and young companies with both the capital and the expertise to launch and grow their businesses and to develop track records of successful companies. Let's look at growth equity now. Growth equity investors provide additional money at a later stage of a company's development. The company has sort of a proven business model. It's got a good customer base. It's got positive cash flows or profits. By providing additional money in return for equity in the company, growth equity investors help these companies expand and become more established. Something to consider and keep in mind here, this additional equity that comes, obviously any additional equity that comes, it dilutes existing shareholders' ownership because logically more investors are sharing the company's cash flow. But the later stage growth equity investors typically have expertise in organizing, getting a company ready for its initial public offering. So they may bring financial benefits that outweigh the disadvantages of dilution. What's a buyout? It's the acquisition of a controlling interest in a company. The acquirer has the decision-making authority over the target company. Buyout investors often target companies that have recently underperformed, but that offer opportunities through restructuring to grow revenues and margins. You must have heard LBOs, a leveraged buyout. What is a leveraged buyout? A leveraged buyout occurs when a greater portion of the purchase is funded with borrowed money, where there is a high proportion of debt. So what is happening here? The acquirer is investing little of his own capital. The debt is later paid through the target company's cash flows. So this is a very interesting structure for an acquirer. He or she gets great purchasing power with minimal investment. Their capital investment is a small percentage of the purchase price. The debt will be paid through target's cash flow. So this can lead to high returns. Now we move to the 4th stage, which is distressed. What is distressed investing? Distressed investing focuses on purchasing the debt of troubled companies that may have defaulted or are on the brink of defaulting. When companies encounter financial troubles, they may be at risk of not being able to make full and timely payments of interest or principal, This is known as the default risk. Mostly investments made in such a company would be at a substantial discount to par value. The thing to remember is if the distressed company can survive and prosper, the value of the investment will increase, often by the conversion of such debt into equity of the new surviving company, and the investor will realize significant value over here. So we started with venture capital when it's at a very nascent stage, very, very risky investment. Then the company is showing decent profitability. It's in its expansion phase. Growth equity comes in. It reaches maturity. Maybe it's going through, maybe there is room for improvement. There are a buyout can happen. A leveraged buyout can also happen. And then it's the decline phase where distress or special situations funding kicks in. Now that we are clear about this basic terminology, let's look at the structure of private equity partnerships. You must keep in mind two terms which you will always come across when you are reading about private equity: general partners and limited partners. A partnership's general partner is responsible for raising capital, finding suitable investments, and making decisions for the partnerships. Think of large private equity firms. They are often the general partners, the GPs who set up the private equity partnerships. Then they are responsible. They will raise capital. They will find investments. They will make decisions for the partnership. The investments are usually not managed by the GP, but rather by a professional fund manager who's hired by the general partner. Each private equity fund may have its own fund manager who's responsible for the day-to-day management of investment in the funds. And GPs typically contribute only a very small percentage of the capital to the private equity partnership. Nearly all the capital to fund investment comes from limited partners. So the key point to remember is general partners have full management control and unlimited financial liability. GPs could lose more than their investment in the partnership because, if necessary, their personal assets could be used to pay the partnership's debts. Let's talk about limited partners. They are the investors who contribute capital to the partnership. Think about institutional entities like pension funds, endowments, insurance companies, maybe high net worth individuals. They are passive investors in the sense they invest their money, but they do not take part in the day-to-day management or the decision-making process. And they will have limited personal liability. They cannot lose more than the amount of capital they contributed to the partnership. So just emphasizing the key points again, general partners have full management control, unlimited financial liability. Limited partners have little or no involvement in management, and their liability is limited to the amount of their investments. General partners are responsible for raising capital. They leverage their networks to identify potential investors. They provide timely update to investors as well. So now that we are clear about GPs and LPs, let's take a quick look at the fee structure. A typical private equity firm makes money through two mechanisms. There is a management fees and there is a carried interest. And I know carried interest is another of those phases which can be quite confusing, but we'll simplify it over here. Management fees are the fees that limited partners, for example, the institutional investors, must pay general partners to compensate them for managing their investments. So it's a fee for services rendered. Simple and straightforward. What about carried interest? It sounds very esoteric, but it is nothing but a performance fee paid to general partners of private equity funds. Even hedge funds have this structure based on the returns of the fund. It's a share of the profit on private equity investment. It's a form of incentive fee that general partners deduct before distributing to the limited partners the profit that they made on the investments. So key points to remember is management fees are typically set as a percentage of the amount of money the limited partners are committing. Additionally, limited partners must pay management fees even if an investment is underperforming, and they must continue paying the management fees even if an investment has failed. Carried interest is designed to ensure that general partners' interests are aligned with the interest of limited partners. Let's look at how investors can invest in real estate. There are two ways to invest: directly or through public or private markets. Private markets, there are two ways to invest. There are real estate limited partnerships, and there is real estate equity fund. What's a real estate limited partnership? These are partnerships that specialize in real estate investments. Now, we'll draw a parallel here to what we just learned in private equity, because the structure and mechanics of real estate limited partnerships are similar to those of the private equity partnerships. A real estate limited partnership is often created by a real estate development firm that becomes the general partner. So now this general partner will raise capital from investors who become the real estate limited partnerships limited partners. Remember what we just discussed. The people who are contributing the capital are limited partners. The capital raised is then invested in real estate projects. Similar to investments in private equity partnerships, investments in real estate limited partnerships, they are illiquid. In addition, the limited partners may face years of negative cash flow because the general partners may not make cash distributions until the real estate assets, the office block or the apartment complex are sold. So think of the J curve that we just discussed, very much holds for this space as well. Let's talk about real estate equity funds. They typically hold investments in hundreds of commercial properties. They are open-ended funds. What is an open-ended fund? They can issue or redeem shares when investors want to buy or sell. They are made out of the real estate equity funds cash flows, such as the income received from rents and the sale of properties. Let's look at public real estate investments, or REITs. REITs are companies that own, operate, or finance income-producing real estate across a wide range of property sector. It's a good option for an investor to earn income from real estate without having to buy, manage, or finance properties themselves. So now we come to our final asset class, which we'll cover today, is commodities. There are three ways for investors to gain exposure to commodities. Buy the physical commodity. The key issue with buying physical commodities is transportation, storage. Where are you going to store a herd of cattle or a bushel of wheat or a barrel of oil? How are you going to transport it in the first place? Second way is you could buy shares of natural resources or commodity-related companies. Investors can buy shares of companies that have a major portion of their operations in the exploration, recovery, production, and processing of commodities. Third way of investing in commodities is through commodity derivatives. What's a derivative? A derivative is a financial security with a value reliant upon or derived from an underlying asset. I'm sure you must have all heard of forwards, futures, options, swaps. Typical commodity derivatives are these exactly, the forwards, futures, options, and swaps.